This is Andy Profit. I'm the Income SIG chair for the AAII chapter. And this is our September meeting, and I wanted to welcome everybody. I know it's been a difficult time for everybody with the fires and the bad air conditions and so forth. I was just telling David, I'm having cabin fever here. Jeannie and I have been in the house for all weekend, and would love to get outside and do some yard work and so forth. But as everybody knows, the conditions are pretty bad. And so this is our usual disclaimer. We're a group that meets on a regular basis to discuss income investing, and everything we say and you hear here should be taken with a grain of salt, because we're not experts by any means, and you should always check with your professional advisors on any of our suggested ideas. It's just a place for everybody to exchange ideas and get information, and by all means do your due diligence. So this is, as I keep saying, we're self-directed. We learn from each other. We look for prudent opportunities, and hopefully that'll grow faster than rate of inflation and preserve our capital. So we're basically a bunch of buy and hold folks who are looking for the long-term solution. And the group we're kind of aiming at are people who are in their late 50s and 60s and into retirement, as this chart shows you. So we're looking for people who are willing to, who have made their stack of money, so to speak, and now are looking for ways to invest it in a prudent fashion to get income out of it. And I hope that you are in that position. And here's a list of suggested dividend investing ideas that I think I've put up a couple of times in the past. There's the AAII site has a newsletter, which is the dividend newsletter, which is pretty good. And then, of course, David Van Epps' series of lessons is excellent. In fact, we worked our way through them over the last year. And then there's a couple of books that are online that AAII offers that are very good. Okay, so this is my schedule for the SIG group next month. We're going to have William Gregg do a little presentation on annuity income. He's been doing some research in that particular area, and he'd like to share that with us. And then our next meeting would be November the 8th. And I'll let you guys know, everybody know, when we get closer to these meetings, so you you're aware of what's going on. And then, of course, as usual, we have a Google group which is available for everybody. It's your site to share ideas and post things there and exchange ideas. I know David has posted a couple of times, and so has Tom and a couple of the other guys. So by all means, this is a place where you can discuss things between meetings and exchange ideas. Be happy to help in whatever way I can. I usually watch it pretty much daily, so don't hesitate to use it. Okay, I just got an email from AAII headquarters, and they have a live webinar coming up on September the 16th. I guess Wayne Thorpe's going to be talking about super value investing. So, and that's at 7:30 Central Daylight Time, which would be 5:30 our time. So if you're around and you want to listen to this, it might be a good, interesting discussion. And I'm going to stop here for a second and ask Todd, are you online? Are you available? Put on,
Yes, can you hear me?
yeah, sure. Go ahead, Todd, please.
Thank you. Yeah, I'm Todd Blickman, staff, president of AAII, the Portland, Oregon Metro chapter. I did want to mention we're going to have a general meeting coming up on Saturday, November 14th. Excuse me, yes, Saturday, November 14th this year, and that's going to be our outlook and projections for both the financial markets and the tax laws on that date. So we're going to be having two different speakers on that meeting as we did last year, and that was very well attended last year, this year as well. And this is, of course, a crucial year, being an election year. A lot of things can change, and so we're going to be discussing the financial markets, where we've been and where we're going, and also potential changes in the tax laws that could take effect whether Biden or Trump are elected. So obviously they'll look different. And so we look forward to having that. That's our next scheduled meeting. And then we're going to be back. And we expect that that will be a video only meeting. It's possible, you know, AI National said no in-person meetings right now. And we expect that that will likely continue to be the case. We don't expect to have an in-person meeting for the 14th of November, but we'll let you know if that changes. But we'll definitely be doing it video as well. So it's a certainty that we'll be doing a video meeting for that meeting. So, and then we'll keep you posted. We'll intend to have the next meeting after that will be January, and we'll let you know as the speakers are confirmed for these upcoming meetings. So, okay.
Thanks, Todd. One other thing I wanted to mention, I don't know if you mentioned it earlier, the AAI Portland chapter now has a YouTube channel.
Yes.
And we have posted up there the YouTube streaming for the June meeting, the May meeting that the main chapter had, as well as the David Van App presentation that he did. And then, of course, Todd and Ron Jones did a presentation as well in April. So those are all up there now on the AAI Portland webinar site. And there's the link right there in your screen. So by all means, if you want to watch something that you missed, there it is. It's there for you to download. And we will also take this recording and stream it as well. I'll ask John Wong to post it up there as well. That may take a few days. He's a very busy guy this time. So, but you know, we'll get that up there within the maybe a week or so. So just kind of watch the site for the posting, so to speak. Todd, did you have anything else to add to that at all, or?
Well, I just want to reinforce that. Thank you for reminding us of that we want to mention that the YouTube, because that's a more robust platform for these videos where we're not going to have capacity issues versus putting them tied to the website, which we traditionally have done. This it's just recently that we have the YouTube channel for the Portland chapter. In fact, it's relatively recent that AI National has a YouTube site for their presentations as well. So we're excited about that. Encourage everyone to check that out. YouTube's a wonderful platform for presenting these extended meetings. So, as I'm sure many of you know.
Okay. All right, so let's go over a few etiquette rules before we ask our speaker. If you're not a member of AAII, we encourage you to join because, you know, that's how we operate. We're here to help, and we'd love to have a member. The site is a fantastic site. Not only are the chapters doing a lot of interesting stuff, but you know, there's a huge resource of information at the AAI headquarters as well. All right, so a little Zoom meeting etiquette. Keep your mic off if you're not chiming in, so to speak. And I'm going to ask Brian Lee Ramage to act as kind of the moderator when we get to the point where we ask Brian Bollinger to speak. So Brian will act as kind of the liaison. So keep your mics off, and then and if you're acknowledged by Brian, then certainly turn on your mic and ask a question. And the way you do that, of course, is that in the lower left-hand corner of the screen there should be a microphone, and you should keep that turned off. And if you've got a question, there's that chat icon, which is kind of in the center of your screen down at the bottom. You can just turn that on and ask a question. And then, or the other way you could do it is you could actually raise your hand, and that puts you in the queue, and then Brian Lee Ramage will acknowledge you, and you can go ahead and speak. That way we have a little better decorum on everything as we proceed. And
Andy,
yeah,
sorry to interject, but
yeah, go ahead. Yeah.
if they wish to, so they can either submit the question via the chat, which is fine, I'll pick it up and then call on them when, after Brian Bollinger has completed his presentation. But the way to raise the hand is actually through the participants button.
Okay.
One would click on the participants, and then that gives you the ability to click on the raise hand, which is at the bottom of the window that pops up when you click on participants. And then that would hopefully I pick it up, that would show a raised hand. But also submitting them as a chat is fine as well, whichever anyone wants to do.
Okay, good, very good. All right, so here's our little pyramid. I show this at every meeting. This is kind of the way I see the risk reward relationship is for income investing. Bonds, of course, are not paying much these days, but these other vehicles are there for your choosing. Okay, let's get on to the real part. Brian, I assume you're online by now?
Yes.
Okay, great. Well, Brian Bollinger is with Simply Safe Dividends, and I'm going to turn my screen over to him, and he's going to present all about himself and about Simply Safe Dividends. And again, there's the etiquette at the bottom of the screen. And let me stop sharing my screen here. And I will turn it over to Brian. I guess, Brian, can you pick it up there, or is that where I need to do something else?
Let me get my screen shared over here.
Oh, there you are.
Does that look good?
Yep, you're good.
All right. Well, hi again, everyone. I hope you're all staying safe with the wildfires out there in Portland. I'm based here in Indiana. And like Andy said, my name is Brian Bollinger, and I started Simply Safe Dividends in 2015. I also have a 3-year-old and a 1-year-old, so I apologize in advance for any screaming or barge-ins that happened during our time together today. But before we jump in, I wanted to take a minute to thank you all for your time, and especially Andy and the folks here who use Simply Safe Dividends and invited me to speak to the group. I'm excited to be here and look forward to the hour ahead that we have. So I understand that as an income-focused group, a lot of you already invest in dividend-paying stocks. So instead of talking about the pros and cons of the strategy, we'll jump right into some of the biggest issues that matter. And if the last 6 months have shown us one thing, it's really the importance of trying to avoid dividend cuts. So we'll spend, I only have about 10 or so slides here that we'll look at before jumping into our website, but we'll spend the first portion together talking about the key objective of this strategy, right? Generating safe cash flow and preserving capital. And dividend cuts get in the way of both of those goals. So we'll start by reviewing why companies cut their dividends. And I'll share the process that we use to help folks identify and avoid stocks that are at higher risk of dividend reductions. And then we'll jump on to Simply Safe Dividends website to look at a few of examples. And then we'll also build a portfolio together, and I'll make sure to leave plenty of time to answer any questions everybody has too. So before we kick off the discussion on dividend safety, I wanted to share a little bit more background about myself and the core values of Simply Safe Dividends. So growing up, I was a baseball fanatic. I'd collect baseball cards. I would look up box scores in the newspaper. I couldn't get enough of the game, but after aspiring to become a professional player, it was pretty clear by around 5th grade that it was never going to happen. I wasn't very good. So I changed my interest a little bit and was set on becoming a general manager of a baseball team. And their job is to evaluate players, sign them to contracts, make trades, to ultimately assemble a championship caliber team. And in college, I went to Indiana University studying finance, accounting, and entrepreneurship. I was volunteering at the athletic department there, trying to pursue this track. And I was doing glamorous tasks like scheduling meals for the women's volleyball team when they were on the road. And pretty quickly, I began to feel this wasn't for me. And around the same time, I discovered investing, and I was hooked because I think there are a lot of similarities with the game of baseball that I love. Instead of evaluating players, you're crunching companies and looking at their statistics, trying to figure out which ones could be undervalued, which ones have something special about them. And instead of building a team, you're building a portfolio of these companies. So I was hooked right away, and I wanted to make a career in investing. And I was fortunate that right after college, I landed a job as an equity research analyst at a firm near Chicago called Ironbridge Capital Management. When I joined, Ironbridge managed around $7 billion. And this was a wonderful experience for me. I loved the work I was able to do, breaking apart companies, looking through filings, analyzing financial statements, meeting with management teams, learning the ins and outs of different industries. It was a lot of fun. But as the years rolled on, I found myself becoming somewhat disenchanted with parts of the industry. A fund like Ironbridge, for example, we managed money because we wanted to try and outperform the market. And it turns out that's a really hard thing to do, not only for individuals, but the professionals as well. S&P had an interesting data point a couple of years ago. They said that in the 15-year period through 2018, 89% of all US actively managed equity funds did not outperform their benchmarks. 89%. And these are the people that do it for a living. They have all the resources in the world. It's really, really a hard objective to meet. And I think that's because if you look at the charts here, the red line represents actively managed funds. So funds, again, that have a full research team and they're trying to beat the market. And you can see on the left, their expense ratios. It's just a lot more expensive to own an actively managed fund. And that comes right out of performance. The black line is an index fund. So think about like a Vanguard ETF. And you can see it's still much cheaper today, even though fees are coming down. So that's one thing. And then information just flows so quickly. In 1990, there were only about 600 websites worldwide. Today, there's over 1.5 billion. So the bottom line is I think it's very, very difficult for most funds to have a chance at beating the market in the long term. So, I was interested in kind of doing something different with my career. And when I looked online, some of these services that target retail investors are just even worse, so much worse really when it comes to performance claims. Promising safe 12% dividend yields or the ability to crush the market or pick the next Amazon stock if only you'll subscribe to their service. And a lot of it reminds me of this story about this gentleman here, Steve Commissar. And he invented the solar-powered clothes dryer in the early 1980s. Steve would market this invention just as a simple text ad in a few different national magazines. Solar-powered clothes dryer, only $50. And so customers would mail in a check to Steve and they would await delivery of their dryer over the next few weeks. And then finally the doorbell would ring, they'd go out to get their new appliance and here's what would arrive. A clothesline, right? Technically it does get the job done, but very disappointing results for what you paid for. And For those of you who are wondering, Steve is a convicted felon. He was actually released from federal prison a couple years ago. So watch out if you're in the market for any household appliances during the pandemic here. You've been warned that he's out there again. I only tell you this because I started Simply Safe Dividends to really be the opposite of all those things. When I sat back and made the decision to quit my job in 2015 to go after this and start this business, I wanted to spend the rest of my career dedicated to an investment strategy that I thought had legitimate, repeatable skill and provided real ongoing value for individual investors who really needed the trusted voice the most. So a conservative dividend investing strategy focused on generating safe retirement income and preserving capital really checked all those boxes for me, and it aligned well with my own personality and investment philosophy. So I left my job to do this and make this vision happen. We provide a bunch of portfolio tracking tools, investment research, stock screeners, a monthly newsletter, and more, all focused on dividends. And we'll get into that later when we start using the website. So with that out of the way, let's jump into some of the more exciting stuff, starting with how to avoid dividend cuts. Most folks that I've spoken with or read a little bit about online when they're talking about how they make decisions for a dividend portfolio. This concept of dividend safety is a big driver, right? If the dividend's not safe, the whole idea of this passive cash flow stream disappears quickly. And a lot of them will look at a few things when they're trying to assess dividend safety. They might look at a company's payout ratio, which measures the proportion of earnings that are paid out as a dividend. They might also take a look at the credit rating to kind of gauge the overall financial health of an enterprise. And usually they'll check some of these popular lists like Dividend Aristocrats or Dividend Kings to see how many years a company has either grown its dividend consecutively or paid one without ever reducing it, to try and feel more confident that the company's committed to the payout. But, you know, as this image depicts here, this cat might find out soon that it's not always easy to identify goldfish from piranhas. And the wave of cuts and suspensions to dividends that we've seen the last 6 months of this pandemic is certainly shown people that that can be true. So let's play a little game here. On the next slide, you'll see 5 real companies. And across the table, you'll see the industry that they compete in. You'll see how long they have paid dividends without interruption. You'll also see the payout ratio, which again just measures the percentage of a company's earnings that are paid out as dividends. So a lot of investors like to see that number be certainly below 100%, comfortably below. And then the last column, you'll see the credit rating. BBB minus and above is considered investment grade. So I'll give you a few more seconds to look at this table, and your job is to try and guess which of these dividends remained safe. You can see that a lot of these companies are in industries that are generally known for stability, like supplying medical supplies to hospitals, selling food containers, fee-based pipelines, energy storage. So, all right, have your guesses ready. We're going to see the results here. And it was a trick question. So I don't know if you guys can see this panel or not. I'll put it down here. All these companies cut their dividends in either late 2018 or early 2019. And what you can see here, the cuts ranged from around 30% to 70%. But what's so costly about a surprise dividend cut is often the permanent capital loss that accompanies the move. So you can see that some of these stocks fell by as much as 44% the day they announced the news. So if your portfolio was, even if it was well diversified, if you're owning any of these types of businesses, not only did you see your income drop, but you also lost a lot of your firepower to move on to an idea to restore that income. You know, in many cases, that's thousands of dollars that just vaporized when the stock responded to this news. So while I'm not convinced that many funds can beat the market over the long term, I do believe that with the right amount of information, the vast majority of dividend cuts can be avoided in advance and are a forecastable event. So we have spent, thousands of hours and hundreds of thousands of dollars to develop, maintain, and continuously improve a dividend safety score system. And the idea of a dividend safety score is that it cuts through all the noise to assess how likely a company is to put its dividend on the chopping block. You can see scores range from 0 to 100, and they fall across our 5 risk buckets ranging from very unsafe to very safe. And I'm going to talk more about how these scores work, but we are big believers in transparency. So if you go on our website, you can see the real-time track record of our scores since we've been in business in 2015. Every dividend cut that's happened across our coverage universe. And all 5 companies that we just looked at in the prior slide scored either very unsafe or unsafe prior to their cut. And since being in business, we've seen 697 cuts or suspensions. And if an investor just focused their portfolio on, there's around 400 or 500 companies that have safe or very safe scores today. If they had just focused their portfolios in those 2 buckets, they would have missed at least 685 of those cuts that have happened. And most of those cuts came in our very unsafe or unsafe buckets. So let's talk a little bit more about how you can get ahead of companies that are more likely to cut their dividends and keep that passive income stream safe and keep your portfolio's value intact too. Again, if you go on our site, you'll see a timeline of all nearly 700 cuts that we've seen come through. And you can read about why each company cut its dividend, what its score was, etc. And if you were to look across all of those events, cutting the dividend, it's one of the last things a company wants to do because it usually signals financial stress and reduced confidence in the business. And that whacks a stock's valuation like we saw with those 5 examples I showed. So the thing to know about sustainable dividends is that they're an output, right? A company needs to generate enough cash flow on an ongoing basis to feel good about covering the dividend without sacrificing on some of its higher priorities, which are to invest in its long-term future as the world keeps changing and competition keeps chomping at the company's profitability. They need to have enough cash to do that, to stay relevant. And they also need to make sure that they're well positioned to meet more senior obligations like making debt and interest payments. So a dividend is an output that is not going to be the very first priority for cash flow use. So if you were to look at, again, the nearly 700 cuts we've seen, they will fall generally into these 4 different buckets. So there we go. You'll see that either the company, perhaps its profits are no longer covering the dividend. We saw a lot of this in the energy sector the last 5 years, right? Oil prices collapsed as the oil cartel basically broke apart, and a lot of companies could no longer generate profits, much less pay a dividend. So they decided to cut or suspend their payouts, recognizing that it's going to be a long time until their earnings power recovers, if ever, in this new normal. Another key reason is the balance sheet is saddled with debt. So if a company is becoming concerned about their ability to perhaps maintain an investment grade credit rating, or their ability to pay off or refinance some debt that's coming due in the future, then cutting the dividend will free up more cash flow they can accumulate to help meet those obligations and get their balance sheet to a healthier place so they can keep investing and not worry about some serious financial issues. Another reason that you see sometimes is a weak outlook for long-term growth. So if an industry is changing, perhaps a sector is moving more online with how consumers buy the product, or technology has just kind of changed the game with the value of what a company is providing and the need to adapt, then they may choose to free up more capital to invest in those areas where they need to stay competitive in the long term. And the dividend can, again, get in the way of that objective. So it's important to understand the industry you're looking at. Like, coal is one example. One of the companies that we showed in that table, Owens & Minor, is another one where they were a medical supplier to hospitals, and hospitals were under pressure to cut costs due to lower reimbursement rates from insurers, as some of the bloat is trying to come out of the healthcare system. So as one of the suppliers to hospitals, Owens & Minor was under a big pinch in their business, and management decided that they needed to try and expand into some adjacent markets to keep the firm's long-term outlook for growth intact. So they made a few big acquisitions that didn't deliver the results they expected, and they ultimately had to cut the dividend, which they had otherwise paid for almost 40 years without interruption. So it's important to understand what's happening in a company's space. The final fourth bucket, generally speaking, of why companies will cut their dividend is they're not sure that they'll be able to keep getting access to affordable financing. So some companies like master limited partnerships, MLPs, or REITs are by design, they're required to pay out almost all of their taxable income as a dividend. They're pass-through entities. So because they pay out most of their cash flow as a dividend, they rely on selling stock and issuing more debt to fund their growth projects. And while times are good, that's fine. There's usually plenty of appetite for that capital, and they can keep running their businesses like this. But if something was to change that would impact their long-term outlook, like during the pandemic, for example, a lot of retail REITs saw their tenants stop paying rent because they were forced to temporarily close. Then investors can be a little more skittish, and access to capital proves to be fickle over a full cycle. So if a company realizes that, hey, we have to keep investing in our future, but investors are not willing to give us capital at a cost that we like, then reducing or eliminating the dividend, at least temporarily, can give us a lot more flexibility to keep investing in our future. So if we know those four kind of general buckets, why a company will cut, our dividend safety score system is really trying to both quantitatively and qualitatively assess all of the factors that lead to those situations. So we're trying to take a conservative long-term view of dividend risk over a full economic cycle, both to avoid whipsawing investors and also to recognize that some of these factors, like debt or cyclical earnings, those can be dormant risk factors until the tide goes out. So having a lot of debt on the balance sheet isn't necessarily a problem until all of a sudden your cash flow drops during a recession and banks or investors are less willing to lend to your business. So we're trying to look at all those things now over a full cycle. And some of the main things we'll take a look at is how well a company's earnings and cash flow have covered its dividend in the past, and the outlook for dividend coverage going forward. That's the payout ratio. We'll spend time, again, assessing how strong the balance sheet is to make sure a company doesn't have too much debt. And importantly, we'll look at those metrics on an industry by industry basis. We're trying to recognize a lot of the important differences that exist in different parts of the market. For example, a regulated utility like Southern Company can generate steady, predictable earnings that are essentially guaranteed by regulators as long as Southern doesn't screw anything up with its projects. And it can afford to maintain a higher payout ratio given the low risk profile of its earnings, really no matter what the economy is doing. And if you were to contrast that with, say, a steelmaker is subject to a lot of factors outside of its control, right? The global supply and demand balance of steel causes prices to move all over the map. A lot of the end markets for steel, like construction, are cyclical. So steel companies, along with their high fixed costs, they can see their profitability swing wildly from one year to the next. So if they're going to pay a safe dividend, it's important that they maintain a much lower payout ratio and they maintain a much more conservatively structured balance sheet so they can get through those good times and the bad ones as well without jeopardizing the payout ratio. So we maintain a much higher bar for a steelmaker to have a safe or a very safe score, for example. And then finally, management's historical commitment to dividends is also important. ExxonMobil is perhaps the best example of this right now. They're struggling like most oil companies in this low price environment. They're really trying to hold on to the dividend as long as they can, but if oil prices don't recover, probably in the next year, that's a company to watch. But their commitment, they've paid an uninterrupted dividend since the 19th century. So, management is really trying to perhaps at the expense of the long-term outlook for the company, they're really trying to hold on to that dividend because it's so important to the shareholder base. So we consider that with our scores as well. All of our websites data updates daily. We pay a lot of money for our financial feeds. Whenever a company's financial picture experiences a material change that could impact its dividend safety, we're notified and we review the situation to determine if a safety score change is needed. We also monitor company news for events like mergers, lawsuits, or other factors that could have a material impact on a firm's future financial health. And if we ever decide to change a safety score, we write up our reasoning and email it out to folks who hold the stock in their portfolios. But again, score changes are rare because we try and take a conservative long-term view to avoid surprises and whipsawing folks from one quarter to the next. So let me take a pause here to answer any questions, and then we can hop on to our website and look to build a portfolio together, and also explore a few options with dividend safety examples. So if you have any questions, either use the chat or Brian, I think, will be able to see if you have raised your hand using Zoom. If not, I can jump into the website.
Oh, we do have one question here.
Okay.
Oh, two. Will you be talking about the play portfolios?
Yes, we can look at that when we hop on the site.
All right. And the second question for now, how often do unsafe or very unsafe stocks reduce, how often do, I think it's supposed to be, do unsafe or very unsafe stocks reduce dividends?
I don't have the exact figures in front of me, but if you were to look at those, call it 700 cuts or suspensions that we've seen happen, I would estimate that probably close to 600 of those came from companies in our very unsafe or unsafe buckets. And in those two buckets, I want to say we probably have somewhere around today, I would guess, 600 to 800 companies. So it doesn't perfectly square off an answer, but the vast majority of cuts have come from those buckets. And if you were to look at the total number of cuts versus the total number of companies, you would get an answer of like the majority of those companies have seen a cut if you were to just count them up that way.
And then Brian, do you cover preferred stock dividends?
So preferred stocks are available in our database, so you can include them in your portfolio to track their income and market value. We don't provide ratings on them today. I could see that being an area we would explore in the future. But if you think about a preferred dividend, generally speaking, it's going to be safer than the common stock dividend. So some of our members will look at the common stock's dividend safety score and make their own assumptions from there for the preferred.
And did Simply Safe Dividends identify the dividend cut for Dominion early?
So the answer to that one is no. If you were to look at our website, I can pull it up here. I'll share my screen. Here we go. So Dominion had a safe score prior to its cut. I wrote up a note here explaining what was going on right on the July 4th weekend. And Dominion decided to divest about a fourth of its business, its gas transmission and storage operations, which were going to represent nearly 25% of its operating earnings. So this divestiture is what led Dominion to reduce its dividend, recognizing its loss of ongoing cash flow. So it right-sized its payout. I'm not sure there was a whole lot we could have done to get in front of this one, since there was a fairly discretionary decision on management's part to strategically leave this part of the business. Dominion's midstream operations were performing well. It was a stable business. Obviously, Warren Buffett liked it to be the buyer of it. And we still hold, Dominion is actually in 2 of our 3 portfolios. We still hold the stock. Dominion's share price dipped on the news initially and then had recovered its losses by the end of the month. So to me, I don't really view this as a long-term indicator that Dominion's business is in trouble. They wanted to move to a pure play utility to try and get a higher valuation and improve their growth profile. So they decided to shed this part of the business. So yeah, that's one of the 12 in our track record that we technically missed. But the good news is at least people who have held on to Dominion like us, they're not seeing, you know, a 40% loss or something on the news. Because again, I think Dominion's long-term value is really unchanged as a result of this decision.
And then are you going to talk about how earnings can be used to more readily hide problems versus cash flow?
I certainly can. Let me pull up the website again here. So on our website, if you were to pull up a company, this is Coca-Cola. Each company has a lot of information on its page, again, updated daily. And one of the sections, we show some financial charts. And we look at payout ratios, both in terms of a company's earnings and their free cash flow. So the earnings that we use on our website, we do use adjusted earnings. So that means they are backing out, in theory, one-time charges. And it's good and it's bad. So some companies, you could argue, take advantage of this by basically having recurring one-time charges for the same issues. Like they have to keep restructuring the business, but they're not, you know, deducting that to reduce their earnings. But overall, across the many examples that I've looked at over the years, I think adjusted earnings is a more representative impact for the vast majority of companies of their actual earnings power. We also, again, like I said, have free cash flow, which is not adjusted for anything. So free cash flow can be noisier because a company might have an unusual year where they invest a lot for growth. So that reduces their free cash flow for that year and makes it look like a dangerous situation. Or perhaps they had to load up on inventory and that reduced their cash flow. So it can be a noisier figure than adjusted earnings. So I kind of like to look at both. And a company that is playing games usually will have other signs of distress. So for example, when we look at a company's balance sheet, one of the areas we hone in on is their debt load. And we're not just looking at, all right, how much short-term and long-term debt do they have? We're looking at other things too, like does the business use a lot of operating leases? We count that as debt. Does a company have a big unfunded pension deficit? We're going to add that to their debt figure. Does it have a financial subsidiary? We'll look at how to handle that. So there's a number of kind of hoops companies jump through with how we evaluate them. And I've not seen an example yet over the last 5 years I've been doing this, at least, where there's been kind of some sort of gimmick with a dividend payer that wouldn't have really been picked up by these different measures.
The next question is, you also do not include fund or ETF ratings. Is there perhaps a generalized score of maybe 80 because of their diversification?
So ETFs and funds are a little bit trickier to evaluate. SPHD is a popular one, the high dividend, low volatility ETF. And it owns 50 companies that are in the S&P 500 that are characterized by a high dividend and low stock price volatility. And so if you look at SPHD's annual dividends over the last 7 years, you can see they've kind of ebbed and flowed unpredictably. They dipped in 2017, then they rose strongly in 2018. If you look more recently, the fund's payout has fallen about 5% since February. And it rebalances twice a year too, changing out holdings and their weights as well. So ETFs are, because they are typically variable payers, I'm sorry, I just realized I'm not sharing my screen here. Let me share that. Because they're variable payers, you never really know what the next dividend is going to hold. Or in SPHD's case, about a fourth of their 50 holdings cut or suspended dividends during the pandemic because, again, they're not focused on dividend safety. So they've had to rebalance their portfolio significantly. So because they pay variable dividends, the bottom line is it's very hard to forecast. Like, how would you put a safety rating on that if you expect the dividend to possibly increase next month and then decrease the next one? So we don't have a rating on them because they're variable payers, but I know what some folks like to do is I'll do it really quick here as an example. If I pull up the ETF, I can download its holdings. Here's the download. And then I can actually import them on the website to see what the portfolio would look like from a dividend safety perspective. So all I'm doing here is I'm taking the fund's ticker symbols and how many shares it owns of each of those stocks. This will just take a second. I'm going to save that file, and then on our website, I can create a portfolio. I'll call it SPHD. I'll import our spreadsheet here. If I can find it. Here it is. It'll bring in the 50 holdings of the ETF. And then we can kind of look at here and see, okay, here's the pie chart. So if you were to look at SPHD's holdings and its dividend income, 20% of its holdings have an unsafe rating, 43% of its income is rated borderline safe, and then 38% is likely safe. So that's why it's difficult, I think, to just slap a general number on a fund. Not only do you have the variable dividend issue, but then they have just this mix of holdings that is probably going to keep being rebalanced because they don't focus on dividend safety.
What bucket would you put AT&T in?
So AT&T, if I were to pull up its page here, we give AT&T a 65, a safe rating. On our site, for a lot of companies, we do have research on their dividend safety score. So if you were to click into any of these research notes, you would see kind of our latest thoughts on AT&T. We last reaffirmed the safe rating in July after the company's earnings. And AT&T is kind of a unique situation. I mean, a lot of companies are. If we were to come down here to its financial section, you can see that the company's payout ratios are pretty reasonable overall, right? Its free cash flow payout ratio over the last year is just under 60%. I think management expects it to be at a similar level in the year ahead. The pandemic's impact, analysts expect AT&T's earnings to dip 11% in the year ahead, which will put its earnings payout ratio a little bit higher, closer to 70%. But the company is still generating a tremendous amount of cash flow. The issue with AT&T is a lot of people talk about it, it's leverage. People want to see that come down, and management's goal is to keep reducing leverage after buying DirecTV and then Time Warner. So we can see here, AT&T's leverage is slowly coming down, but as long as the pandemic doesn't cause a material decline in its cash flow, something a lot worse than analysts and management currently expect, we continue to think that the company will generate enough to both keep paying its dividend and keep improving its balance sheet over time. So until that changes, we expect to keep our score where it is at, safe rating. And if there are no other questions, I can jump into a few dividend safety examples, and then we can build a portfolio together, if that sounds good.
There don't appear to be any further questions at this time.
All right. Let me share my screen again, and we will jump into a few examples here. All right, so we can start with Johnson & Johnson, a dividend king. You can see here at the stocks overview, we give it a very safe dividend safety score. Has a 2.7% yield today. And if you're using this page to take a closer look at Johnson & Johnson, you'll see under its dividend safety section here, a high level view, kind of a quick hit of some of the key metrics we look at that usually will provide a lot of the story behind a company's rating. So with Johnson & Johnson, we can see that over the last year, its payout ratio has sat just below 50%. And over the year ahead, based on analyst earnings estimates, we think it'll stay close to that same level. So that's pretty conservative. It provides a lot of cushion for J&J to retain cash flow and to weather any unexpected bumps that would reduce its earnings. The company's balance sheet is also just in really good shape. So one leverage metric we'll look at is net debt to EBITDA. And that looks at how much debt Johnson & Johnson has minus its cash on hand. And it divides that by the company's EBITDA, which it's similar to cash flow. And it's not a perfect measure, but I've found to be a pretty good measure for apples to apples comparisons between companies. So this is telling you basically how many years would it take Johnson & Johnson to use its cash flow and its cash on hand to pay off all of its debt. And in this case, 0.55 leverage ratio, so about half a year. That's really low. And even if you were to look at some of the lawsuits facing Johnson & Johnson, which we've analyzed in our research up here, if you kind of assume like pretty pessimistic scenarios for how those are resolved for both the opioid crisis and talc powder, Johnson & Johnson, we think, would still maintain a very healthy balance sheet. It wouldn't threaten the dividend. You can also see the company's been really committed to the dividend, paying it for over 50 years, growing it actually each of those years. During the 2007-09 financial crisis, it increased the dividend. Its sales only dipped 6%, which was better than most companies. And when the S&P 500 fell 55% from October 07 to March 09, Johnson & Johnson only declined 27%. So did a much better job on a relative basis of preserving capital. So those are some of the main reasons to support Johnson & Johnson's score. And again, if you come down to its charts, you can see again, just the model of stability, right? Its payout ratio today is really unchanged over the last decade. You can see the company's earnings have pretty steadily marched upwards. Cash flow has been excellent as well. If you go further down the page, you can see these are about like the 12 or so metrics that I think that matter the most when you're analyzing a business. And our charts explain what you're looking at and why it matters underneath each one. Finally, you can see on Johnson & Johnson's balance sheet, the low leverage ratio we talked about. So it gives you more confidence in the financial picture for J&J. I'm going to contrast that with another company, Chevron, that is rated safe, but you're going to see that its charts look a lot uglier, right? So if we look at the key metrics here for Chevron, you can see its earnings are not covering the dividend. 181% payout ratio over the last year and close to 300% expected in the year ahead. But Chevron's saving grace and really the main driver behind its safety score is its balance sheet. So the oil market has had tons of ups and downs. Chevron has historically been able to grow its dividend 33 straight years. You can see that its payout ratio during the 2015-16 oil crash jumped to nearly 500%, but the dividend was kept intact, right? How can that be? Well, if you were to go down and take a closer look at Chevron's balance sheet, you can see management has managed it really conservatively because they know that there will be periods of time where oil prices plunge to levels that don't generate enough cash flow to cover the dividend. But because they value the dividend, they are willing, within reason, to borrow money to use their balance sheet to cover the short-term deficit. So if you were to look at Chevron today, you can see in 2015 and 16, its net debt to capital ratio, which measures, it basically takes debt and divides it by the company's debt and equity to tell you what percentage of a company's financing is coming from debt capital rather than equity. And the more debt you have, the riskier that type of strategy is, because you're subject to refinancing risk. You're really saddled with some pretty big obligations, unlike equity. So you can see on our charts here, we kind of prefer to see below 30% for oil producers. And Chevron has always been below 30%. It rose during the 15-16 oil crash and then came back down to sit near 20% today. And Chevron has said that they think even if oil stays at $30 a barrel this year and next, and they borrow to maintain the dividend, their debt to capital ratio will stay below 25%. So management, they can't survive this situation forever, but I also don't believe that oil can stay at $30 a barrel forever either. So Chevron is willing to stay committed to the dividend during this downturn because they have the balance sheet to do it, unlike a lot of their peers. One final example we can look at here, United States Steel Corporation, which has had a very unsafe score pretty much forever. If you were to look at their dividend history, you can see it's been all over the map. When times were good before the financial crisis, they more than quadrupled the dividend when their profits were booming. But then when the tide went out, they lost money, they had too much debt, and the dividend went right back to where it was in 2004, in 2010, and it stayed there until they cut it again. Earlier this year, they dropped it from 5 cents a share to 1 cent. And if you were to look at United States Steel, it's easy to be fooled, right? 2017, 2018, their payout ratio was 10%, 4%. If you were just looking at that as a snapshot for risk, you'd say, oh, wow, the dividend looks great. But you can see their earnings collapse, right, when the market went against them. They barely broke even in 2019, and now they're losing money this year, and they're expected to lose money in the year ahead. So this is a really tough industry to find safe dividends. And by taking a long-term view on a company like this, it's going to be extremely difficult for a business like United States Steel to ever score well for dividend safety. Before going into any more examples, I think we should build a portfolio together, and I can kind of show you how I stay on top of things doing that. And
Brian, excuse me.
Yeah.
Before we do that, we have a few questions.
Okay.
Lately, the insurance companies are looking interested. What is the SSD score for Allstate?
Pull it up here. So a lot of insurance companies have sold off for two primary reasons. One is interest rates have come down significantly. So insurers invest most of their floats, so the premiums they earn before having to pay out claims, they'll invest them in bond portfolios. And when they reinvest, when bonds mature and they have to reinvest to keep earning income, they're now having to reinvest at much lower rates than most people had imagined. So their investment income outlook has weakened, which is not necessarily a problem if it doesn't last forever and the company has conservatively managed its obligations and portfolio. And the other reason is the pandemic has created some uncertainty in various areas where a lot is going wrong all at once, right? It's kind of a simultaneous occurrence of risk. In a case like Allstate, they have seen their earnings hold up quite well so far. Their payout ratio is below 20%. It's expected to stay that way. Their balance sheet and capital ratios look really good as well. So based on what we know today, at least, we don't see risk to Allstate and its dividend. And
then do you think that total return over some time period should be a factor in evaluating a company when one is an income investor? Or is it okay to consider dividends, yield growth, safety?
I think it comes down to what you're trying to do. I mean, most of the folks that use our service are not looking to beat the market. The three portfolios that we have that are in our newsletter that I actively manage, We provide detailed performance records for each of those with the total return information compared to benchmarks and all that stuff. And I think with a conservative dividend strategy, it's not unreasonable to expect to at least kind of keep pace with the broader market over time while delivering higher income, more of your returns coming from dividends. So I don't think anyone should get so hung up on, is the total return beating the market or keeping pace with it even. If your goal is to preserve your capital and earn income that grows over time, I think this is a great strategy. You don't have to make it harder than it is. In terms of evaluating a company, yeah, I think if you were to look at a longer window of time and see what the stock's total return has been, that can be kind of telling. If something has failed to create value for shareholders for 10 or 15 years, I think you really have to ask yourself, is this time really different? Or can I find something that has a better track record and importantly, a better forward-looking outlook too?
How do you view share buybacks for companies, and what metrics do you watch to make sure that buybacks are not excessive?
Yeah, that's been one of the big themes coming out of this pandemic, right? A company like Boeing was a big buyer of their own shares. You can see on our chart here, shares outstanding have fallen from 770 million down to 566 million. And buybacks in theory sound great, right? Who should know better about a company's intrinsic value than the business and its owners itself? And why not buy those shares back at good prices compared to that value? Well, what typically happens is it's not used that way, and the buybacks happen at inopportune moments when a company is sitting on more cash than it knows what to do with, usually when times are good and share prices are high. So I don't pay a whole lot of attention to share buybacks. I mean, sure, if I think it's a great business that's going to be larger and more profitable in 10 years and the valuation is reasonable and the company has the cash without risking its balance sheet to do it, yeah, I'm happy for them to buy back shares and increase my relative ownership of the business. But for me, it's really just, are the buybacks risking the dividend by stretching the balance sheet and saddling the company with too much debt? So we're paying attention to those metrics. That's really the only connection to buybacks that we have.
Next, please describe how SSD handles stock splits like Apple's August 31st action.
Yes, we do handle stock splits. I've pulled up Apple here on my screen, and you can see that we've adjusted the metrics for Apple as a result of its split. We get a lot of our data that comes in will automatically adjust for these things too. You can see there is a little funkiness here. I guess there was one day where the yield and the earnings hadn't adjusted compared to the price. There's like a funny spike on the graph here. But yes, we do stay up on those things and adjust our website to reflect them. You can see that Apple's historical dividends have been adjusted for the split. So yes, it's something that data integrity and accuracy and timeliness is huge for us. It's such a core component of what we try to do. So we are staying on top of that stuff.
That's all the questions we have at the moment.
Okay. Let's go ahead and do some fun stuff here and build a portfolio together. So there's a few ways you can add a portfolio to our website. You can either enter your positions by hand. You can import a spreadsheet like I showed you with SPHD, where you're listing your stocks or funds, your shares, and your cost basis. We also offer the option, if you want to, you can import directly from your brokerage account. I'm not going to do that today, but we do support Schwab, TD Ameritrade, Vanguard, E-Trade, Fidelity. My business partner, Matt, and I both use this option. It's powered by a business called Plaid, which is owned by Visa, so bank level security, all that good stuff. But for our exercise today, we will just do it by hand. So we'll do a Portland play portfolio. We'll choose to enter our holdings here. Feel free in the chat to enter any stocks you want me to include in this portfolio. We'll theoretically buy 100 shares of each. I'll do AT&T, Energy Transfer. And Brian, if anyone is entering something in the chat, just let me know and I can throw it in here.
Sure.
As it
How
comes
about
in.
Allstate?
We'll get Allstate in there.
Prudential,
Prudential,
IBM,
IBM.
J&J, Pfizer, Chevron, Exxon, Store, STOR. How about EBF, Procter Gamble, Kroger, Annaly, NLY,
Yep.
WBA, CVS, Costco,
A lot of good companies in here.
Cisco, 3M, AT&T. I think AT&T is already in there, right?
Yes. We can just grab a few more if anyone has final wishes.
ENB, Edward, Nancy, Brian.
All right. Let's run with this.
Now, see, we already have Microsoft. Someone suggesting Microsoft, Google, and
Okay.
WPP.
All right. So I click add these holdings and then boom, we've got a 25 stock portfolio here. Again, I just put in 100 shares of each, so the position weights could be all over the map. And I'll show you with a few minutes here, I'll kind of walk through some of the things that I do when I look at our portfolios to assess that I'm staying between the guardrails. So, I mean, income is the highlight of the strategy, right? So if I click into our portfolio's income report here, I can see that based on the company's dividends today and their payout schedules, that we're projected to generate about $6,200 a year from this portfolio. And you can see how it breaks out by each month in the year ahead. You can also sort by that information here and see how the math works out with how many shares we own and what the company's per share dividend is in each of those periods, as well as any upcoming payments here that are hitting the account. We're constantly improving the website. We're actually working on a few improvements with this report that are going to be coming out soon. But I know a lot of folks are interested in this stuff. And it's the fun part of the strategy, right? It's the output. But, you know, again, it can be a little deceiving if you're not focused on dividend safety. So if you were to look at this portfolio's income as a percentage of the total, you can see that you guys did pretty well. A lot of the companies that are put in here have score well. So 82% of the portfolio's income has a safe or a very safe score, 12% borderline, 3% maybe unsafe, and then 3% unrated. And if you click into the dividend safety report, again, you can read through how to think about each of these measures and what they mean. So in the unsafe and very unsafe categories, we have NLY and Energy Transfer. If you were to, in this case, Energy Transfer, we do have some research on it. If you were to click the company, it would open up its page. You come down here to its dividend safety section and you can see, okay, the company used to have a borderline safe score, and then in July, we downgraded it to unsafe. Rising leverage puts more pressure on the distribution. You could click in here and read our thoughts on why a downgrade was appropriate and be more informed for how you want to go forward with your own portfolio. Borderline safe, Store Capital, Exxon, Enbridge. So people like having this information here because not only can you just look at it like I just did now, but Anytime any of your holdings announces a change to their dividend, so an increase or a decrease, or we publish research on it, or we change your dividend safety score, you'll get an email right away that tells you all those things. And you'll also find this information in your timeline. So I have a few portfolios entered on this account. And just to give you an example of how that looks. So American Tower raised its dividend by 3.6%. So that's going to boost our income by $14 a year as a result. Philip Morris, you can see that notice came through recently. We published a note on Coca-Cola July 22nd. So you can really stay on top of all the big things that are going to matter for your holdings. It's just really convenient, even if you're not big on checking into websites. We're not going to bombard you with anything, but it's going to be there when anything big happens that you need to be paying attention to. I'll go into the dividend growth report now. And this shows you, okay, based on the portfolio you put together and the current shares you hold, how would your dividend income have changed over the last decade for all the companies you own that paid a dividend during that time? And you can see with our portfolio, it's pretty good. We would have generated about $2,500 in income in 2008. And without reinvesting dividends, that would have grown to over $6,000 last year. So about 8% annual growth over that time. It slowed a bit to 5%, but seeing this is a lot better than seeing, a chart that kind of jumps all over the place or is declining, certainly. It gives you a sense that, if you think the future remains just as bright for these businesses, that probably bodes well for your portfolio's income to kind of keep its up and to the right trajectory. You can also come down here and kind of play around with, all right, well, if my dividend grew at 4% versus 8% going forward, how much income would I have in 5 years, 15 years? Just to kind of see the sensitivity to those different annual growth rates. A final thing I'll show you here in the portfolio tool is this diversification report. So if you open that up, you'll see your sector mix. And as a general rule of thumb, I like to try not to invest more than 20–25% of my portfolio in any given sector, just because surprises can happen. And if I'm trying to preserve capital, I don't really want to be 25% in energy before a major shock were to happen. So you can see here, communication sector is 47% of our portfolio. I guess putting in 100 shares of Google caused it to be a 45% weight, which really pulled that up. But again, it just kind of is a quick report to make sure that you're staying within the guidelines that we'd like to see. And then same thing, if I click the income tab here, I can see how much each holding is contributing to my overall dividend income. IBM is our biggest weight here at 10% of our income. So I like to keep this kind of limited to 5% or less. And if you were to go to, just really quickly here, this will tell you so I have multiple portfolios entered here just really quickly. These are the 3 model portfolios in our newsletter: top 20, conservative retirees, long-term growth. If I view all of them together, this diversification report will communicate those guidelines, right? So it says, okay, your portfolio looks well diversified, no sectors more than 25%. And if I go into the income tab, it's again going to remind me that, okay, here are your top sources of income. We suggest that no individual stock contributes more than about 5% of your total income. And with this big diversified portfolio of everything I've entered here, we can see Johnson & Johnson's a 4% weight on down the list. So it's just good to know like what you're betting on the most. And you can see that here. Final thing on the portfolio tool, a lot of people like this holdings table down below. You can add a lot of different columns that you might be interested in. So anything from like the beta of the stock, you can insert yield on cost, PE ratios, dividend safety score, percent of income, dividend growth streak, ex-dividend dates, payout ratios, leverage ratios, recession, dividend and return. It'll save all these settings here. You can sort any column. and make decisions and make comparisons a lot more easily. You can also export all this information into an Excel file to play around with further too. It's just nice to, if I'm trying to make a decision in our newsletter portfolios, it's just going to be helpful to see this, right? I can quickly see a stock's dividend yield chart over the last 5 years to know if the yield is relatively high compared to its history, making it interesting or not. I can see how the safety score looks. I can get a visual of the dividend growth the company has exhibited. So a lot of this information just comes to life quickly to help with decision making. Another part of the site I'll highlight quickly is the screener. So again, this is built for dividend investors. So you can filter on dividend safety. So if you wanted to only search for companies that had a safe or a very safe score, you can add that filter. You can see now there's 445 companies available. Maybe we only want companies that have paid a dividend without cutting it for at least 20 years. So we could add that filter. Now there's 238 to choose from. Maybe we only want yields between 3% and 6%. We're down to 85 companies. Payout ratio, maybe we only want those that have kind of a low or very low payout ratio for their industries. We're down to 45 companies. So really, like, whatever metrics you care about, recession performance, ex-dividend dates, leverage, growth streaks, P ratios, that's all going to be in here to help you. And again, all this information updates daily. You can customize the columns. So we're trying to make it really simple to help folks find ideas that are appropriate for their risk tolerance and their goals. And if you do find interesting companies, you can either throw them into a watch list portfolio or into your real portfolio. And then we're going to do a lot of the heavy lifting going forward, right? We're going to send you notifications on things that are changing. We're going to keep posting research on companies we cover. Certainly, if a dividend safety score changes, you'll be notified right away with what's changed and how we're thinking about it. There's a lot of information I just shared. I want to leave some time for questions, so I'll turn it back.
Brian, is there a way to view details regarding additional purchases or sells?
I assume that means for one's own portfolio. If you were to, say you had Allstate and you bought 50 more shares, you could click this edit link and either enter a purchase. All right, I bought 50 more shares. You can enter a sale, or you could edit the information directly with the shares you own and your cost per share. If you're talking about kind of tracking these, you could add, an Allstate holding every time you make a trade. Like, I'm adding a new entry here for Allstate. I bought 50 shares at 40 bucks. And then you will see 2 entries listed for Allstate. We don't have the dates of these transactions available, but you can have multiple entries here if you did want to kind of track your different trades that way.
And we have a comment here, outstanding website.
Thank you. It's been a lot of fun the last 5 years working on this. We're a small 2-man team, if you can believe it. My business partner is our tech expert. We've been great friends for over a decade. And it's just been a lot of fun to wake up and work on this every day. We don't do any marketing. All of our time is spent improving the website and doing research. And we've been really blessed. All of our growth has come from people spreading the word about our site. We don't lift a finger with going out. And I only did this presentation because a few folks who are members wanted me to come in, and it's fun to connect like this for me. So I enjoy the break from the usual grind. Any others?
No more questions at this moment.
Okay, well, I will say this. If you do have any other questions ever, you can reach out to us on our website. I'll log out here. If you go to simplysafedividends.com, there's a support link at the top. If you click that, you can shoot us an email, and either I will personally answer it or my business partner, Matt, will. We answer all of our emails. We don't outsource anything. We also offer a free 2-week trial, no credit card required, no obligations, nothing like that. So we try to make it easy.
Brian,
You have words of praise. Thank you from a longtime SSD member. I found your support via email excellent. And then there's a question, what is the subscription cost?
The subscription is $3.99 per year. It comes with a 60-day money-back guarantee because we're only happy if you're really happy with the value you're receiving. So the 2-week free trial is no obligations. You won't be charged anything after the trial. And if you do choose to subscribe, you still have that 60-day window to decide for sure, like, this is great value. I'm really happy with it.
Brian, do you do a fair valuation on a company? I mean, do you give some kind of a fair value of what that company might be? How do you go about doing that?
Yes. So valuation, at the firm I was an analyst at, we had really detailed, it's a discounted cash flow approach. So, modeling out a company's future, figuring out an appropriate discount rate, a lot of assumptions went into it. And my approach to valuation is more, for this type of strategy, it's going to be more aligned with what's known as dividend yield theory. So the idea behind this, I went on Johnson & Johnson's page here down to its evaluation section. And I think that over time, the market is generally pretty efficient for stable companies that have fairly mature businesses and fairly constant dividend policies like Johnson & Johnson. So if you were to look at over the last
Can we see your screen, Brian?
Oh yeah, I'm sorry, I forgot to share it. So if you look at a company like Johnson & Johnson, I'm in its valuation section here. My belief for, again, mature businesses with stable dividend policies, safe dividends, and ones that don't have a very dynamic long-term outlook. In other words, their kind of range of outcomes is not very broad. I believe that over a period of time, the market is going to be pretty good at kind of assigning a normal valuation for that firm based on its yield and P/E ratio. So for Johnson & Johnson here, you can see its dividend yield over the last 5 years has been remarkably stable between 2.5% and 3%. And its P/E ratio is kind of traded in a similar band between kind of 15 and 18 times earnings. So my belief is if you think Johnson & Johnson's outlook really hasn't changed compared to the last few years, you think the dividend is still safe, then that 5-year average is probably a pretty reasonable price for Johnson & Johnson. And if the yield is creeping above that line, then it could be an interesting buy for the dividend. If it's significantly below the line, then you think it may revert back to the mean at some point if you think nothing has changed for the company's future. So we kind of use this as a rough guide to value. The main goal is just to avoid overpaying for a company. So if you were to come in here and see like, holy cow, like Apple's a good example. And I don't know what Apple's future holds. Their company could change a lot more in the future with all the cash they have on hand to reinvent themselves. But you can see Apple's P ratio has gone from around an average of 15 times for years to now, if you were to go back like a month ago, it's almost 40 times. So if you were to look at Apple, you'd have to think, boy, do I really feel like Apple's long-term growth profile has increased that much to be worth that much more than it historically has been? I'm not so sure. So we kind of have these charts here, and they're available in our tables too, just to give people a quick visual of is the market pricing this company significantly differently than it has in the past? And how do you feel about that? We kind of ask you to, like the text here for Apple says, the stock could be overvalued unless you believe the company's long-term outlook has strengthened. So for my approach is I want to buy a high quality business. Apple definitely checks that box. I want to buy a company that I think has a really safe dividend that can grow. Apple checks those boxes as well. The third part is the valuation. And that would be my only pause here with Apple. I'd probably want to hold off a little bit just looking at these charts. So I don't believe in specific target prices or things like that. I think if you're staying diversified between the guardrails, you're owning good businesses and companies that have safe growing dividends, you're going to own some stocks that end up overvalued, some that end up undervalued, but the winners will offset your losers, and I think you will keep up with the market over time.
Well, the tech sector seems to be overvalued. I was looking at Microsoft the other day, and it is really, really overvalued. So I was curious as how that.
Yeah, you can see the same thing here. So Microsoft,
Yeah,
it had over a 3% yield back in 2015. If you had only been smart enough to see this future of big tech, and its P ratio has expanded from, again, below 20 just a few years ago to look like it was 35 times earlier this year. So
yeah, it's crazy. Huh.
not to say these are bad businesses, but yeah, if Microsoft were to take a turn for the worse somehow and people lost faith in its future, then you could certainly look at, a period of pretty low returns until it grows into that multiple.
Very good. Very good. Very impressive.
And there's an article too, I should say. We have a blog. Here it is. There's an article here called Dividend Yield Theory Explained, and it walks through what that theory is and then kind of some adjustments we make to our own approach to valuation with different examples in there. Like this was a PepsiCo yield chart. Its yield shot up in 2018. I'll pull it up on the site. It's one of the stocks we hold in our portfolios. Its yield shot up in 2018 to almost 4%. And then you can see it kind of came back down to that long-term average once again. And same thing during the pandemic. So I think it's an interesting rule of thumb just to follow. And again, the goal is really just to avoid paying an excessive price. But I focus primarily on the fundamental research and staying diversified. That to me takes precedence over valuation across an entire portfolio.
So Brian, when you're in the forward PE ratio that you're showing here, that means that a group of analysts have come together and said, oh, we think the PE ratio for the next couple of years is going to be this, and that's how it's plotted there? Is that what
Exactly.
I'm interpreting it to be?
So if you come down to Pepsi's financials, you can see its earnings per share in the next 12 months. That's based on consensus estimate from analysts. I would guess there's over a dozen analysts covering Pepsi. So
Okay.
that's the combined best guess.
Mhm. Wow, very good. Any more questions for Brian?
None that I see.
Anything in the chat? In the hand raising thing there, Brian? Is there?
No, I don't see any hands raised. All the questions have been coming in through the chat.
Okay. Okay. Well, I think this is we're almost at 3 o'clock here. Are there any other questions for Brian? I think this has been an outstanding. I'm impressed. This is very nice service. I know that there's a couple of guys in our group that subscribe to this and have found it very, very useful. I think it's probably something that a lot of the guys in the group should be thinking seriously about. It's a good service, looks like to me.
I may convert, Brian.
Well, there's no pressure.
Okay, Brian, if you can release your screen, I'll pull back up here.
Okay, I think I'm no longer sharing.
Okay. All right, well then I will go back here and share. Okay, so let me move to the next slide here, if I can somehow. Oh, can't do it for some reason or other. Yeah. All right. So I just want to, first of all, thank Brian Bollinger for this presentation. I think this is outstanding. As an income investor myself, I'm always looking for ways to save myself some time, and this is, for $400 a year, I can save a lot of time. My portfolio has, I don't know, maybe 25, 30 stocks in it, and so keeping track of them is just huge time sink. And so something like this could really help save some time for me. Thank you very much, Brian. I really appreciate it.
Say, Andy, this is John. I've just remember one question.
Yeah, sure.
For Brian, which is I subscribe, but I notice there are some of the companies I look for ratings on, they're not rated. How do you decide between which companies you're going to include and rate and which ones not?
Well, a lot of work goes into monitoring the coverage universe between keeping up on news and then being notified whenever financials are changing materially for a company. So we try to focus our coverage on stocks that are generally more popular with income investors, and then those with higher yields. So think like close to 3% on up. We will look at usually tweaking our coverage at least annually. So feel free to shoot me an email with those companies, and I'd be happy to give you a few thoughts and consider them next time we look to expand. We cover around 1,000 companies today. It was closer to, I think, 1,300 or 1,400 before the pandemic, when a lot of companies suspended dividends and no longer have something we can rate. But yeah, feel free to send over the tickers, and I'll give those a look.
Okay, thank you.
You bet.
Any other questions for Brian?
None that I see.
Okay. Brian Lee Ramage, thank you very much for moderating. I really appreciate that.
Oh, you're welcome.
Just to wrap things up here, again, we have our Google group, which is available. If you have any ideas that you want to share with us, or some area of interest, some asset class that you want us to explore, again, it has to be income oriented. Don't send us anything that's wild and crazy, because we're not interested in that. But yeah, we're always looking for topics, and we're always looking for speakers. So by all means, don't hesitate to send me an email or give me a call, or post it on the Google group, and we'll try to do some homework on it and try to find somebody who can talk to this intelligently. Okay, so the next meeting is going to be October the 3rd, and try to stay away from the social media sites if you can, because this guy is going to represents kind of what happens when you go to a social media site. I will be wrapping this thing up here pretty shortly. So if there aren't any more questions or so forth, I will say thank you very much for attending, and I will be stopping the recording here, and wishing everybody safe and sound year, and we'll be meeting next month on October the 3rd. Bye-bye.
Bye-bye.
Thanks for having me.